Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined today by Shaun from Not a Yes Man Economics, and we're going to look at the UK housing market. Is this bubble deflating? Are we going to see house prices rise in 2018? What's your take on the whole UK house market?
Well, there's various impacts here because I wrote pretty much at this time last year that I thought that we'd see house price falls in the UK this year. Certainly a fall below the inflation rate. And in fact, yesterday we had the sort of Halifax price numbers that covers only Lloyds Bank customers for mortgages now, but it still fees fair bit of the market, that the annual rate had accelerated to 4.5%. So it's been this year, in fact, bumbling on. And if we look sort of beneath that, firstly, we see some extraordinary regional differences in prices. Would you believe the highest borough, 1.2 million, Kensington, Chelsea? I think that's still too low, actually. But anyway, and then somewhere in Wales, I'm about to mispronounce, I think, something like Blaenau and getting 82,000. So there's enormous scopes and differences in the market. But if we look at the situation, what we see is if we look at actual, what I call establishment policy, both the government and the Bank of England, it's been extraordinarily favourable, has pushed this through, and it's not really, I don't think, been as well understood as people might think. Now, there was the announcements recently from the government about Help to Buy, another 10 billion. Now, they're in such disarray at the minute, we don't know whether that will come in or not, even though the minister that will be doing it, let's face it. But if we go underneath that to the Bank of England, it put quite a lot of effort in terms of what's called the Term Funding Scheme, which essentially was cheap money for the banks. Rather than having to go to the pesky trouble of getting depositors in and that sort of thing, the ordinary way of oiling their wheels, they could get money as cheap as their bank rate, which was 0.25% then, from the Bank of England. And if we look at the exchange of letters between the Governor and the Chancellor of the Exchequer back in August, which discussed an expansion of the potential size of the scheme to 115 billion, we see Governor Carney in effect boasting that mortgage rates have fallen. So this was the policy here to keep house prices going, which has carried on until now, as far as we can tell, in spite of the fact that many other measures of it you would think would bring it down. For example, the way that real wages have struggled this year and the fact that prices were already high and had a really good run, you'd think there might be some sort of fading. But in fact, we find that the party keeps going. Now, looking forwards, however, though, there are a couple of things on the horizon. Firstly, the possibility that the base rate rise, although it was only 0.25%, that's nudged some mortgage rates higher. The variable ones, tracker ones, have gone up. But then again, there's an undercut to this, because one of the things, if you look at it, that is a signal for fixed rate mortgages is a 5-year gilt yield. Well, that's dropped. So that, from Bank of England's point of view, is a bit embarrassing. It had gone to 0.82% before their announcement. This morning's dropped again to 0.68. Not an enormous thing in the scheme of things, but we could see someone putting in some cheaper fixed rate mortgage offers, which you wouldn't necessarily quite expect after a bank rate rise.
We're in a situation, I mean, if the Bank of England, I mean, it's unlikely to go on a steady rate hike curve, and we all know that. But if we see inflation in the UK go up, this could be a result of Brexit, or Brexit negotiations not going too well over the next couple of years. And we've seen the house market, it's been certainly very healthy over recent years. If we start to see a correction in house prices, what will the Bank of England do to react to this? Will that change their plan on interest rates? And obviously, bear in mind, could see a rise in inflation. Now seems like a new element for the Bank of England to really take on board. Do you think that could be an issue going forward?
Yeah, because I think that if say we had a slow decline, they might ignore that. If we had anything more than that, I'd expect them to step in immediately, because it's just become so much a sort of part of the policy. Now, this whole central bank thing and the concept of wealth effects, we see it in another form at the minute. So many stock markets hitting their highs, for example. I forget it was 13 or 14 days in a row, but the Nikkei 225 in Japan has gone to near-term highs. Well, theatre in terms of roughly 20 years, say, of course, well below what it hit in 89, 90. But that is presented as a success and triumph. But yet when you look at other measures, for example, just staying with wages in Japan, they continue to struggle. So we say again, the imbalance of the modern world is which those with assets are doing quite well, whereas if we come to other measures of people trying to make their way, wages and things like that, they're not. But the central banks are so, to my mind, committed to this game, so much skin in the game, if you like, that I think that they would just immediately charge back in. QE for mortgages, who knows? I wouldn't put it past them. Maybe bank rate back to 0.25% again, or to zero, or even go negative. Although there I do have a cautionary note, because if you look round at countries that do have negative interest rates, mortgage rates don't fall a lot further than what we have already. Classic cases are looking for that, say Sweden and Switzerland have that. Looking at even places around Europe, they've not fallen a lot below here, so there's not an extra gain on that, but it doesn't mean they wouldn't give it a go. So the playbook, I think, is almost whatever they can find.
Understood. And you mentioned Halifax, obviously owned by Lloyds, and they've got a huge amount of skin in the game, more so than they did 10 years ago. Will the Bank of England obviously be aware of how precarious still some of the UK banks are and these mortgage lenders? If people start getting in arrears and defaulting on mortgages, will they look at the financial sector as a whole now and look at that with concern?
Definitely, I think, because that has been their priority really through the whole phase. If you put it in Lord of the Ring terms, the banks are the precious and it must be protected. And that, I think, would see them coming quite quickly. And if you look at different parts of the UK, there are lots of different patterns. Yeah, the average, it's got that. London's gone through the roof and the areas around him. But there are other areas that have done quite poorly. For example, somewhere like Northern Ireland. I was looking at the numbers the other day, and according to the official statistics, your average price there got up to 225,000. It's been doing well since 2013, but now it's only more like 130,000. So there was quite a drop there. So virtually everything over there is going to be underwater unless people had enormous equity in the first place. So could be quite a sort of strong regional impact. It's been quite hard in London to lose money. You'd have had to have quite a sort of rat trap or something, wouldn't you, for the price to have fallen in recent times. So less so there. But in other areas that have not seen the sort of rises that we've seen around the regions, then there could be pressures on them. And obviously this could be particular banks that specialise in certain areas. A bit like how we got into this mess with Northern Rock in a way. It's not inconceivable.
Understood. A decade on, not much has changed. Well, on that note, Shaun, thank you very much for joining us.
Thank you.